Good morning. We are still Monday, the 15th of September. Markets have been open for about a half hour. Hope everything is going well for you so far. Wanted to do a segment where we talked about spread orders. Spreads, a lot of different kinds, and you can use them in so many different ways. But you're buying and selling a similar security, not the same, but a similar option. The strike will be different unless you're doing a calendar spread. Most common are your vertical spreads. That's where you're using the same expiration and you're just buying and selling a different strike of the same expiration. Let's take a look at a few examples here. Certainly one of the most common, if not the most common, is a bull put spread. As its name implies, it's a bullish trade. Some of the things that are common to all verticals, you know the reward to risk ratio, how much you could make versus how much you could lose. You know that at the time that you place the trade. In the case of a bull put, you take the difference between the strikes. Then you take out the initial credit that you bring in. That gives you your maximum possible loss. Then that same initial credit that you brought in, that's your maximum possible gain. If you take that max gain and divide it by the max loss, that gives you your reward to risk ratio. Now you can be very aggressive or less aggressive with this trade. The greater the initial credit that you bring in, the higher the initial strike that you sell. That's going to give you the biggest possible income, but it also gives you, at least statistically, the lowest likelihood of having a winning trade. You can go to the other extreme. The further out of the money that you sell your short leg, the less income you'll bring in, but statistically the greater percentage, greater likelihood that you will make some money. Let's put on a few examples here. Now it's a bullish trade, so it begins with your forecast. Here we have Apple. I've got up a daily chart. I have a 30-day moving average, simple moving average, not exponential. I have a stochastic and a MACD. Now try and move my face out of the way here just a little bit. Okay, my MACD is turning over. My stochastic is really kind of giving us a neutral signal. We have been in a little bit of an upward trend recently. This could be potential resistance. We did appear to recently bounce off of support. So I would be mildly bullish on Apple. Not really bullish, but mildly bullish. But we're after illustrative purposes anyway. So we'll proceed. Slightly bullish forecast on Apple. Now I've got here a table of different strikes, my bid, my ask, and so forth. Theta and delta are also pretty important. It looks like I've cut my deltas off just a little bit. I want those here, so let me just move this a little bit. Now there's other things we could put on that would also be useful. But let's just start with the basics here. Now if I'm really aggressive, and I'll do this for illustrative purposes again, but if I'm really aggressive, I'm going to sell in the money. So one thing I might do is sell here. So here's my in the money. I'll sell. And I can go close or wide. We'll talk about that as time goes by. Let's go close for this first one. I have a 2.5 point spread. I've got a $1.37 credit. Okay. So the most that I could lose is bouncing around, so I'll lock it here. But as it is right here, the most I could lose would be 250 minus $1.37. All right, doing it in my head, that comes up with $1.13. That would be the most we could lose. The most we could make would be that initial credit, whatever it is, in this case, $1.37. I'm going to unlock it. It's still at $1.37. I'm going to confirm and send. And we'll see, it may or may not fill while we're on the call here. If I have to, I'll accept a worse price to get it done. Next one that I want to show is kind of similar thinking. Now let me take off this and the risk profile right now, not showing me anything. Okay, we did get filled. All right, so that's where we would be right now. If it'll just behave itself and go up a little bit, this would be the max we could make. This would be the max we could lose. And those should be represented by the numbers that we were crunching. Looks like we may have filled a penny better than we initially thought. Let's take these off. And let's put on a different trade. This time, let's say that we're not quite so confident in our forecast. Now we could structure this with any of these strikes, and we can go wider than one strike. We'll give more examples as we go forward. But let's say that we're not too confident in Apple going up, but we do think it probably won't go down. So we're going to sell the 230s and cover them with the 227.5s. Now our reward to risk ratio is much, much worse, right? Much worse. We could only make 37 cents. We could lose $2.13. So not fantastic that way at all. But the likelihood of the stock getting above 37.5 for our max profit on the first trade versus staying above 230. We can even be wrong about the direction. We just need it to stay above 230. So place this trade. I'll place more as we go along and talk about this in the future, but here's what our risk profile would look like just on this trade. Okay, you can see everything's shifted. The likelihood of us staying above this break-even point, much, much greater than the first trade we were looking at. So a lot of it comes down to our risk tolerance and our confidence in our forecast. All right, I'll post this and then we'll talk again tomorrow.